In this video, I want to talk a little bit about Boeing, and I want to use Boeing as an example for a covered call, and I want to talk to you about a covered call. Now, I know that as soon as I said the word covered call, half of you are going to want to shut off the video. Don't. Let's talk about this for a minute, all right? Stick with me. I want to talk to you about a kind of a different way of thinking about covered calls. All right, so we're going to use Boeing as our example for this covered call, but before we start off with Boeing, I want to just give you a little story about my apartment. Now, I have a little condo that I rent to some college students. All right, so I bought this when my son was going to college. He moved out, and I kept the condo, and I rent it now. So let's take this as an example. Let's say this condo is worth $100,000. Let's say I paid $100,000 for it. I paid a little less than that, but it's worth about $100,000 right now. So it's worth $100,000, and I'm renting it for $1,000 a month. That's pretty good rent, right? Now, if we were in a real estate business, we would think that was pretty darn good. Let's go do 10 of those, right? We'd be rich, rich, rich beyond our wildest dreams. We'd have $10,000 a month coming in, and that would be a great income source for us with a bunch of little apartments. So let's do this exact same thing, only let's do it in the stock market where we don't have to go over to the house every once in a while and clean out the toilet or clean out the sink or repair the refrigerator or any of that kind of stuff. We're going to try and take this idea, this concept of owning real estate, only we're going to do it in the stock market. Okay, we're going to do basically the same thing. We're going to have our asset, which is our apartment complex or our apartment building, or in this case, a single apartment, and we're going to rent it out. Only we're going to do it through the stock market. So how can we do that? We can do that with covered calls. So the way we do that is we're going to come over here, and I'm going to just pull up Track and Trade, and we're going to use Boeing as our apartment. We're going to buy one Boeing apartment. How's that? All right. Now, the concept here is that we're going to buy the shares. So let's just come in here and buy the shares. We're going to buy 100 shares. We just buy the shares. Now we have 100 shares of Boeing. So we just bought an apartment. All right. So now if the value of the apartment, think about the apartment. When we I bought this apartment years ago, 10 years ago when my son was going to college, right? And so I just held on to this apartment for 10 years. Now, as real estate values go up and down, do I care that the value of the apartment goes up and down and fluctuates? Yeah, of course I do a little bit. It's in the back of my mind, but I don't really think about it, right? Because I'm collecting $1,000 a month rent off of it every month, irregardless of what the value of the apartment does. So in good times, the apartment goes up in value. In bad times, the apartment goes down in value. But overall, I don't really care. I own the asset. I have the asset. I have the apartment. And eventually, maybe in 5 or 10 years, if I want to sell it, my hope is that it's worth more than I paid for it. And if I wait long enough, that's probably going to be the case. Maybe not. Maybe, real estate prices will collapse and I'll have to sell my apartment for less than I paid for it. But in the meantime, I'm going to collect $1,000 of rent through the whole time period that I own this apartment. So we're going to do and mimic the same thing over in the stock market. So I'm going to buy my Boeing apartment. So I just paid, in this case, I paid $18,000 for this apartment. Okay, so not $100,000, but $18,000 for this apartment. So I now have an apartment, which I call Boeing, and it is my apartment. Now, if the value of the apartment goes up, or if the value of Boeing goes up, great, that's wonderful, I'm happy. But if it goes down, I'm not really worried about it because I'm not going to ever really sell it, right? This is going to be something I'm going to pass on to my sons when I die. This is going to be an apartment that I buy, and I am never going to sell it. So a lot of us are in a situation where we buy stock, and we're like, okay, well, we own this stock. How do we make money off of it? Well, we have to sell it to make a profit off of our stock. But if we don't ever want to sell the stock and we just kind of want to pass it on to our kids as an inheritance, then owning the stock is basically worthless to us, right? Because we're never going to sell it, so why own it? You're not making any money off of it. So what we want to do is we want to make rent, right? We want to make rent off of this Boeing apartment that we bought. So we bought it for $18,000 and we want to make a little bit of rent. So how do we make rent on shares that we own? And the way we do that is we sell covered calls against them. Now, it's a real simple concept. And as long as you don't ever plan on selling the Boeing apartment, right? then you can just sit there and collect rent, collect rent, collect rent. And maybe someday in the future, Boeing will be more valuable than what it is today that you bought it. And that's the whole idea of covered calls, is that we're not going to really worry about the value of the underlying stock. We're just going to collect the premium on shares that we sell against it. So let's come over here to the options tab. Actually, before that, this is actually the monthly view of Boeing. And the reason I'm using it as an example is because we can see that Boeing has been as high as $446. So the profit potential of this Boeing has the ability to go up here, in this case $24,000, if it just goes back up to the peak of where it was. And it's down here pretty low, so we're buying low, selling high. We got a good price on our apartment. Now in the meantime, as we anticipate or look for the value of our apartment to increase in value, or the underlying stock in this case, we're going to set that aside and we're just going to collect rent all the way through. All right, so here's how we collect rent. So we're going to go through and we're going to come down. I'm going to go down to a smaller time frame chart. That's a monthly chart, all right? So if we come down to a weekly chart, this is what Boeing's been doing on a weekly basis. It came down. It's kind of making just this kind of a big, long, curve, and we're anticipating the curve going to rise in price once again. So that's kind of how Boeing's been moving. So on a daily chart, daily time frame, this thing's really been kind of rocketing up. So we've got our little wave pattern here, and we're probably going to expect some sort of a little pullback and then a continuation of the rally. Now we bought high on the daily chart. We bought up here as this market's making highs. We generally like to buy low, right? Buy low, sell high. But in this case, because we're doing it as a scenario and I want to kind of teach it to you so that you can prepare for it, I'm not exactly saying that this is the exact best timing for Boeing. I'm just using it as an example. Now, I want to give you the example so that you can prepare to do this yourself. Now, obviously, if Boeing takes off, you'll be wish that you would have bought it here. But if it turns and falls back down, you wish you would have sold it there. But in the long run, we don't really care. All right, we don't really care because, again, we're going to buy this apartment and we're never going to sell it. So it doesn't matter what the underlying stock does. So all we're going to do is we're going to come down to the daily chart, and we're going to come in here and we're going to sell a call against it. Now, how do we do that? It's very simple. All we're going to do is basically tell the market that we are willing to sell our shares, our 100 shares, at a higher price. That's all we're doing. Okay, so if we come in here and we sell a call option, okay, we get to collect the premium. Now, what we're going to do is we're going to do this. We're going to think about the rent. The rent is, if you rent your apartment, you generally collect the rent once a month. So we're going to come out here about 1 month's in rent, somewhere around 30, 35 days. You can go into 40 days if you need to, but you want this highlighted one, this dark one right in here. So you kind of want to do this every 30 to 35 days. 30 days is kind of a good time frame because that's where that theta curve starts to fall off. And if you're not familiar with what I'm talking about, get with me. I'll talk to you a little bit about theta in my class. We've talked about that, so I don't need to go into that great detail here. But we're going to go out in about 35 days, and we're going to come in, and we're going to just go to a simple option. All we're going to do is we're going to sell a call. Now, because we have 100 shares, we can only sell one call. So we sell one call, and that call is going to be covered by the shares that we're buying. So we own the shares. We have the 100 shares, and all we're doing by selling a call out here is saying I am willing to sell my shares at this price, okay, before that purple line. So if you can see over here on the left-hand side, it's going to tell you this is $310. So we're going to basically collect $310 on our 100 shares. If we go out a little farther, we're going to collect $209 of rent. Okay, or if we come in a little closer, it's $452 in rent. Now, what would make you decide to do one versus the other? Some guys like to put it right down here at $637, or right on top of it at $877. You could sell a call at $877 and collect that premium, and usually we'll do it 1 or 2 clicks out. But nonetheless, you could put it relatively close. You could put it a little bit further out. This is how much rent you're going to collect. Now, I'm going to talk about here in just a second the difference in value of why you'd want to collect $200 versus just coming right down here and saying, I'll collect the full $877. All right. So this is a situation where you're going to come in, let's say $640. So we're going to collect $640 in rent on our option, or on our long 100 shares. So when you sell a call option, you get the premium. So if we sell it, we're going to let's go ahead and do it. Let's go in here. We're just going to mark it into this thing. We're going to sell that thing. Now we have $630. Now I bought 100 shares and I just sold 100 shares. All right. I just bought 100 shares and I just sold 100 shares. And what did I sell them for? I sold my 100 shares that I bought with an option, and I collected the premium of $630. So that's what I sold my 100 shares for, $630. So you can say, well, Land, how much would it have made? Let's zoom in here a little bit. Had it gone up in shares. If it would have gone up in shares from here to here, I would have sold them for $539. So I'm actually selling them for more money than what I could have sold them for if they went up to that level and then I sold them. I would sell 100 shares if it went from here to the red line and I sold my 100 shares, I would make $539. But if I do it with an option, I get to collect $630. So I'm actually making more money by selling the option and holding on to the shares. Now, I've made a contract that I am willing to sell my 100 shares at that price. So they're going to give me $630. But what if the Boeing falls? And we've anticipated that maybe Boeing's going to fall at this point and won't continue to rally. So what if Boeing falls? Well, I could lose a whole bunch of money on my Boeing shares, right? Because they could go down. They could go down and I could lose $1,524 if it went all the way down to here. But do we care? Why do we care? We're just going to give these to our kids when we die anyway. We don't care. Right? We don't care what happens to the shares. We don't care what happens to the value of the apartment that we're renting because we're worried about collecting the rent. That's all we want to do. And the great thing about this is you've already collected the rent. You get $630. You get to collect that rent. You can go spend it right now. Go out, take the money out, run down, buy a dress for your girlfriend. Go, just don't tell your wife that you bought a dress for your girlfriend. All right. So that's the situation here. You've got $630 in the bank that you can go do whatever you want with. Now, granted, the value of the shares could fall, but again, we don't care. We don't care. That's the apartment complex. We're going to hang on to that for the rest of our lives anyway, so we don't care. Now, what if the stock went up? Okay, what if the stock went up? So here's the situation that's going to this is what scares people about covered calls, is because they're like, oh, no, the stock went up above my red line. Okay, so what happens is you come up here, and what if the stock shoots way up here before that green line, that purple line right there? Well, the stock increases in value at $1,682. So if you would have just had the stock and you wouldn't have collected the rent, okay, the difference between an apartment complex collecting rent and the difference between the stock market is that if you collect rent of $630 and the stock goes shooting way up above your red line, which is kind of why we only want to do 30 days. We don't want to do like 200 days on our rental agreement. We only want to do every 30 days we do our rental agreement. So the likelihood of that happening is very slim, right? I mean, it could, and it could rise, and it could rise above. By how far could it rise above? It could go a long ways above, right? But it's going to stop making money at that red line. So the maximum amount of money that you can make if you sell your shares, which is what we've done, we've contracted to sell our shares. So we bought our shares here. We've contracted to sell them here for $630. But what if the market goes clear up to here? Well, if the market keeps going and you think it's going to keep rising, buy some more shares. Right? I mean, you could buy another apartment and it can continue to rise. You sold these. You've contracted to sell these 100 shares for $630 at this price at that purple line. So at that purple line, you're going to sell these shares at $630, no matter what they're at down here. Now, if the market falls, they don't make you sell the shares. You just hang on to the shares. You keep the loss if the market goes sideways. If the market even rises a little bit, it doesn't matter. The only time that you have to sell your shares is if it goes above the red line. And they may exercise, take away your shares, and then you just go and buy them back again. It's no big deal. The part that scares people is in the meantime, if this market rises and comes way up here, it looks like on paper in your account, it looks like you're losing a whole bunch of money. All right, because they're going to reflect in your account the loss of these shares, and they're not taking into account the profit of this share, these shares here, the 630. But they do at the end. At expiration, it all comes out in the wash, and you make your $630. And if the stock's way up here, you just didn't make any profit above the red line because you contracted to sell them for $630. It'll show the loss on your paper. It'll show a big nasty loss over here, and that's the part that scares people with covered calls. As long as this market's way up in this region here, it's going to show a big nasty loss. In fact, it'll even show a big nasty loss down in here. If the stock starts to rise, it's going to show kind of a nasty loss over here in your accounting. But at the end, doesn't matter because it can all come out in the wash. They clear off all that loss and they just give you get the $630 and they take your shares away. If the market is above here, they take the shares away. You're like, okay, I'm fine with that. I just buy more shares. No big deal. You just go and buy your apartment again, and you do it again, and you collect the rent again. And if the market falls and comes down here, no big deal. You don't care. You collect your rent. You collect your rent. You do it for another month. Collect your rent. Don't matter. Collect your rent. Collect your rent. Collect your rent. It doesn't matter as long as the market, the only thing that you have to worry about is if it goes up above your red line, well, they're going to take your apartment away from you, which is no big deal. You just go and buy it right back again. Okay, because you still made your $630. The only thing you did is you lost any profit potential of your shares above the red line. That's it. Okay, so the closer you get your red line, the more money you're going to collect on rent, but the less likely you're going to collect an increase in value. So that's why a lot of guys will just put it right at the money. They'll just buy them and sell them. $800, they're happy with that. If it goes up there, they take their shares away. They bought them and sold them, make $800. That's their rent, and they just do it again next month. Okay. So that's the name of the game with covered calls, and that's how you'd set up Boeing to be your covered call apartment building.